Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA N Raja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice. Had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. There's a company called X Limited. It has invested in a project, let's say 100 crore, setting up a big project, land and building, plant and machinery, a factory and all. They've taken up this project with an expectation of getting 15% return on investment. It means they have invested 100 crore. They are expecting 15% return every year. They are expecting 15% return every year. It means they are expecting a return of 15 crore. Okay. So what is the message? The message is this business should make a profit of 15 crore. Only then the expectation can be met. Okay, this is the understanding. Now listen. Now let's see what this business has achieved in terms of sales. And you are also getting another important information, that is the profitability. This business has a profitability of 15%. Okay, incidentally both are matching. Okay, incidentally both are matching. That is profitability of 15% means for every sales they'll make profit of 15%. If they are selling for 100 rupees, they make a profit of 15 rupees. If they are selling for 300 rupees, they make a profit of 30 rupees. Okay, that's what the profitability communicates here. Okay, now listen. We know fixed assets are 100 crore, right? Okay. The sales is 50 crore. The sales what they have achieved in a year is 50 crore, and we know profit margin, that is profitability, is 15%. So what would be the profit for this business? 50 crore into 15%, the profit is 7.5 crore. So at this point I have a question for you, whether the investors in this business will be happy. Will they be happy? Because they were expecting a profit of they were expecting a return of 15 crore. It means they were expecting the business to make a profit of 15 crore, but this business has made a profit of only 7.5 crore. So investors will not be happy. Let me give you another scenario where the fixed assets are same 100 crore, but sales is 75 crore. They have put in some more efforts, but the profit margin is same 15%. So what will be the profit here? 75 into 15%, it is 11.25 crore. 11.25 crore only. Whether the investors will be happy, at least now answer is no, because they were expecting 15 crore. Okay, let me give you a third scenario. Fixed assets are 100 crore and sales is also 100 crore. And what is the profit margin? 15%. So what is the profit? 15 crore. Whether investors will be happy now? Yes, now they'll be happy because they were expecting a return of 15 crore. This business has made a profit of 15 crore, so there is matching. And here they'll be happy because the profitability of this business is 15%. But on the other side, if the profitability of this business had been 10%, then even 100 crore sales will give profit of only 10 crore, whereas the expectation is 15 crore. In this case, incidentally, the profitability and expected return on investment are one and the same. Let me give you a fourth scenario where fixed assets are 100 crore, same, whereas sales is 125 crore and this business can deliver 15% profit margin. It means the profit is 125 crore into 15%, that is 18.75 crore. Here, yes, investors should be jumping with joy because they were expecting 15 crore, whereas businesses delivered 18.75 crore. But here also it was made good because the profit margin is 15%. What would have happened if the profit margin is only 10%? For a sales of 125 crore, the profit would have been only 12.5 crore. For a sales of 125 crore, the profit would have been only 12.5 crore, still not matching the expectations. Okay, but okay, luckily here the profitability is 15%. Now listen, very critical. In first two scenarios, the sales are lesser than fixed assets. In the third scenario, sales is equal to fixed asset, and in the fourth scenario, the sales are greater than fixed assets. So when the profitability is 15% and when the sales are less than fixed assets, we call this as inefficient utilization of fixed assets. Because to get that 15 crore, they have to achieve more sales because they have fixed assets of 100 crore, but sales are not even matching the fixed assets. That's why we say it is inefficient utilization of fixed assets. And when sales are equal to fixed assets, and when sales are greater than fixed assets at a given profitability of 15%, we call this as efficient utilization of fixed assets because those sales are delivering 15% profit margin that is matching with the expected return on investment of 15%. Okay, so and it's here this ratio comes into picture, that is fixed asset turnover ratio. That is net sales divided by average fixed assets. So we know the net sales are 50, 75, 100, 125. You divide the net sales by fixed assets. 50 by 100 gives you the ratio as 0.5:1. 75 by 100, 0.75:1, 1:1, 1.25:1. And what that communicates, for every 1 rupee fixed asset, they are making a sales of only 50 paise. So because of that only, it's not matching the expectation. For every 1 rupee of fixed asset, they are making sales of only 75 paise. So whenever the ratio is below 1, that communicates inefficient or underutilization of fixed assets. And when the ratio is equal to 1, as an investor, you can be happy provided the profitability also matches the expected return on investment. Otherwise, you have no reason to be happy. And the fourth scenario, 1.25:1, it means for every 1 rupee fixed asset, the sales is 1 rupee 25 paise. Here you can be happy provided the profitability matches the expectation. Okay, so how a fixed asset turnover ratio should be ideally? Fixed asset turnover ratio should be 2:1. For every 1 rupee of fixed asset, there should be 2 rupees of sales. Only then it will make some justice, because not everywhere you will have the profitability matching return on investment expectation. In this case, I said 15% is the profitability, 15% is the return on investment, right? But if the profitability is 5% and if the return on investment expectation is 15%, then even 100 crore, 200 crore sales will not do justice. Okay, so it has to be understood with reference to that, with reference to profitability. Okay, and this is what we understand from fixed asset turnover ratio. So this fixed asset turnover ratio, you cannot prescribe any benchmark specifically. So if you want to really understand the efficiency of the business with what efficiency they are utilizing the fixed assets, you have to compare that ratio with peers. We have to compare with industry as well as the past, and this ratio is very important for business which are capital intensive. Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer. Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2, that is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like auto credit facilities, letter of credit and all. So far I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, Collateral Securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over, some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.